Hey everyone, just welcoming everyone back for the February 2023 economic and market update. We're all back from January holidays and Christmas and that sort of thing, and January sort of flew by I know it did for me. How was your break, Andrew?
Yeah, absolutely. It was fantastic. I had an extended break, so we had the usual office shut down for a couple of weeks, and so it was very nice to have time with the family and just that usual time of year, which is special time of the year.
Yeah, it is good, isn't it? Yeah, it is good to get away and spend a bit of time away from the laptop and that sort of thing. What about you, Shane? What did you get up to?
I had a nice break. Feels a bit of a distant memory now in the middle of...
I know. Well, we're doing the update now.
I know,
right?
but, no, it was good. I mean, as to echo Andrew's sentiment, I mean, any time away with the family is very, very nice. So, but no, my family stayed away for a little bit longer. I came back, so I had a little bit of quiet time as well to myself, which was kind of nice, coming into the office while the family was away. So,
good chance to get a bit of stuff done in January too, often.
Agreed.
Yeah.
And you watch a bit of cricket?
Yes. It was supposed to be more cricket, but my son, who is the cricketer, he injured himself, so he wasn't able to play that second 2 weeks of cricket. So just 1 week, but did go to the Test match. That was fun. 2 days, and then a couple of other games here and there. It was good. All right, let's get into it. So I guess be familiar scenes here in terms of what we've been through in the past. So what we're looking at here is the GDP growth of most advanced economies around the world. So we've got the US, we've got Euro, and we've got Japan. And I can see, we can all really see that we've had a fairly significant reduction back from the post-COVID highs, or that period post-COVID. And then, so GDP growth is, sitting for most developed economies around about 2.5%, 3% at the moment.
And I think it's, if I add to that, Cal, I think it's interesting now, and we spoke about it just before Christmas last year as well, these GDP numbers, and again, the story is becoming very clear about the cycle of the pandemic, and sometimes it's important not to forget those big spikes in this GDP number, that they were in response to very unusual circumstances around the world, where we were obviously locked in our houses globally, and then we got out of our houses, and then everyone had money to spend, so they went and spent it. And you
clearly, look at that.
I mean, GDP, and importantly, when you see a fall in GDP like that, it can be a bit alarming. But what's more notable there is that we're starting to trend back more to kind of longer term average, which is probably a positive, if you will, rather than a negative looking at that chart.
Yeah, definitely. It's nice to see. And then obviously GDP growth in Australia. Interestingly enough, we didn't see the significant lows that they saw in Europe. I think we saw a -14 or -15 GDP, and a positive 15 over in Europe, but we didn't see that here in Australia. We've seen not a significant impact, I suppose, from a GDP perspective, as compared to other developed countries, but still holding fairly firm at a tick below 4. We're waiting for an updated set of GDP growth numbers, which will be interesting to see when they come out, because they would be expected to be lower, I would have thought, than
they should trend down now.
Yeah.
What's happening out there.
Yeah. All right, CPI Inflation. So these have been updated since we last did the video cast. So we got to a tick below 8.
It's peaked
in Australia.
I reckon it's peaked.
Yeah. It's interesting, isn't it? So, Shane, you were saying just off air before that certainly in Australia we've lagged a little bit from as compared to other countries.
Yeah, I think it's been notable, and sort of just commenting earlier, that even through the cycle of the virus, we compare to North America and Europe, we've been sort of behind the whole way through this pandemic. These numbers, CPI numbers, I think speak to that a little bit, where we're seeing around the world, inflation trending down globally now, whereas our numbers still haven't seen that little tick down, which will give us all a little bit of relief when we see that chart just spike down a touch. But I think more broadly, I mean, what is very apparent there is it's a big number, isn't it, right? And we're all feeling it when we go to the supermarket or the petrol bars or diesel. It is becoming expensive to live. Wages are certainly higher, and so this is going to be an interesting kind of 12 months ahead as we start to unwind a little bit of this inflationary issue that we're living through.
Yeah, absolutely.
And I think then there's the expectation when it'll get back to that normal level. So they're talking, as late as late 2024, 2025, or it might get back to that normal sort of band of 2 to 3%.
I actually read a stat on that before, and it's interesting, kind of like the short-termism of forecasts sometimes, right? But the stat was the last time the US had inflation as high as they had, it took 6 years to get back to 2%.
Did it?
6 years.
6 years.
Yeah. So the article was not a doomsday by any stretch. It was just more highlighting the fact that stats often don't lie, and it did take 6 years to fully unwind. So perhaps I'm not making a comment of we don't take 6 years to get back to our normal numbers, and I don't think we can compare to previous because we have lived through this very unusual situation. But yes, I think it's that stickiness of inflation might just hang around for a little while, won't it?
Late 80s, I reckon that would have been. Yeah. Well. And then obviously inflation in advanced economies. I guess one of the things that really jumps out at me here is when looking at both the United States and then also Europe, we've started to see a trend down in terms of what those inflationary numbers look like. So, the US particularly got as high as 9, and then now in the latest print, we've seen that turn around, and that's getting closer to the 6s, and certainly in Europe it got up around 10 with 9.5, I think, and then started to pull back towards 9 now already. So what would the reason for that be? Do you think?
Oh look, I think it's now in response to. Again, I don't think we can lose sort of sight of actually what took place to cause the inflation, and that significant amount of government spending and stimulus that the world experienced is now stopped, of course, right? So and then also you overlay that with the rapid increase in interest rates, and admittedly, America's interest rate, or their correlation between the official cash rate and their mortgages is different to how we experience it here. But having said that, we've just had money come out of the economy, basically, right? And just been squeezed straight out. So from the complete extreme of having it pumped in en masse, like we've never seen before, to now having it stripped out again, like we haven't seen before. That reversal is certainly, quite clear as to why.
And I think the other thing is too, these numbers lag. So this latest set of numbers there, they're talking or dealing with data that was back in sort of December, so these numbers lag, and actually when you look at say some of the consumer expectations, they've really dropped off a cliff because people are feeling it now, right?
Yeah.
Hip pocket feeling it.
Yeah. And I think the related, and I think we've got a slide on it, unemployment. So that's still been holding quite strong, but you would expect at some point that's going to fall away. And as that falls away, then the inflation rate really should start to pull back based on economic theory. And
well, that's right. Yeah, that's right.
And if I could add to that as well, we had investment committee last week, and talking through these stats, through investment committee, it's quite an interesting set of numbers that we find ourselves living through today. And I think you're right. I mean, unemployment hasn't yet followed, right? It's there, and kind of we haven't seen the full impact of the rate rises, come through. And Australia's got that very interesting situation where we've got, something like 40% of houses have got a mortgage attached to them, and there is a significant proportion of those that have been in fixed interest rates that are starting to roll off now and over the next 3 or 4 months. So we've had 9 or 10 consecutive rate rises now, is it?
Yes.
So 10 consecutive rate rises, whilst a good chunk of mortgages have been fixed. So they haven't really felt any change to lifestyle other than obviously the food pressure and petrol pressure. So that's going to be a very interesting kind of thought for Australia broadly if we do have that kind of rapid bite, and whether that does play through and then unemployment follows because businesses contract rather than there being an expansionary phase.
So that stat, fixed home loans going over to variable, that was my understanding that was about half the mortgages out there will revert to variable in the next 6 months.
6 months, I think it is,
6 months.
And we're talking sub 2 to 5-ish, right?
Well, so it's what's that, a 250% increase in the cost of having a home, right? Because that's the cost. For most people, that's the cost.
Yeah.
That's dramatic.
It is, and it hasn't been felt yet here in Australia.
No.
Right?
So that will, again, as we've just chatted about, that's going to cause people just have less money.
Yeah.
So
And maybe it's worthwhile just digressing slightly, just maybe pointing out the difference between the American model versus the Australian model, just for people's benefit.
good idea.
So the Australian model, as we see the Reserve Bank tick up their interest rates, our variable rates follow suit, of course, as we all kind of see and feel here domestically. But in the US, when someone takes out a home loan in the US, they get kind of a fixed rate from the outset, and it typically lasts 30 years, irrespective of what happens in the rate cycle. So you see the US rate sitting at 4.75 today, significantly higher than what we are here. But that hasn't necessarily had that same correlation. Their mortgage rates are probably still sitting below 4.75.
Yeah.
So, I think Australia's got that very unique situation where it needs to be carefully managed, and it probably speaks a little bit to Governor Lowe's commentary and sort of, it's somewhat criticised sometimes for taking his time more than what the rest of the world have. Yeah. But that's a very different set of numbers to what the rest of the world has got too with mortgages.
Yeah, great point. Absolutely.
It'll be interesting this year for sure.
And then it's the level of those mortgages, right? So we obviously saw the escalation in the price of houses.
Yeah.
As part of the pandemic, and as a result of that, people took out some fairly large debt on these lower fixed rates because interest rates weren't going to go up. Was the line. So I think it's that not only
is that the same thing as property prices don't go down?
That's correct.
Right.
Yeah.
Okay.
Yeah. So not only it's not the tripling of the interest rate, but actually it's the magnitude of that effect on the level of debt.
Yeah. And I think even to think about wages, we were talking before, and unemployment. One of the things that we don't always see the correlation between when money's basically free to borrow, the propensity for people to go and spend is significantly high because confidence is high.
Yep.
And even use an example of someone doing a home renovation that might cost $100,000 or $150,000, let's say, as an example. If you've got to pay 5 or 6% for that home reno at $150K, suddenly you're paying $9,000 a year in terms of interest to service that.
Yep.
Whereas when it's at less than 2, it's $3,000 a year, and people don't even think twice about it. They go, well, why don't I do the home reno?
Yeah, I need a new kitchen.
Yeah, I need, and it's kind of like that's the unwinding of inflation right there. I feel and then the subsequent movement in unemployment because those decisions that are so easy when money is free are no longer easy anymore because there is a genuine trade-off. And and look, in fairness, it should be a trade-off, right, to make those sort of broader decisions. But we're now getting used to kind of a new norm, if you will, about what that trade-off, what we're prepared to give up going forward. I just thought I'd raise that because sometimes we don't always see that correlation between how inflation actually unwinds. No. And that's going to be curious to see whether the regulators get it right.
Well, look, that's actually supported by the data we've got here too, right? So consumer sentiment now is as low as it's been, in the last 10 years or so. Yeah. So how people are feeling about the future, it's been designed this way. This is the point.
Yeah. And feeling worse than they did at the start of the pandemic when we had the virus broke. Right?
Yeah. That's actually
quite
fascinating.
Right? We all remember that thought at that time, thinking, my goodness, the world's about to end.
Yeah.
And now where people financially are feeling the same, if not worse.
Yeah. That is fascinating.
Yeah.
Which then translates to behaviour, so they, start to tighten things up, maybe save it a little bit more, and then, as we were talking about before, with the conversion of fixed to variable rate, you could even expect that to perhaps go a bit further south.
Yeah. Another telling stat, I like this one, savings ratio. So it's pretty hard to see, but you can see it almost got up to 20%. That's pandemic. Yeah. So people can't spend money. So we're saving nearly everything we're getting. And interest rates dropped, right? And now we've seen that come back. But it's still around just slightly higher than the level it's typically, which is at around about that 8% mark. Yeah. Which is about super. Super's 10, right?
Yeah. Yeah, that's an interesting number, isn't it? Look, what I find fascinating there is too that some of the earlier rate rises have been consumed and cost of living being consumed with savings. and now savings have come down, but also our savings capacity is being absorbed because simply
cost of living's gone up.
Cost of tank of fuel is crazily expensive.
And to your point before, Andrew, around house prices, that little chart there sort of gives a bit of an indication that we've seen a bit of a drop off. And then certainly here, housing prices year on year growth, we're down into negative territory now, obviously. So, that market does move around, and is primarily directed by, in my mind, could be wrong, by the level of interest rates and how expensive it is to actually own a house. Supported by housing loan commitments falling off as well. So less people getting loans, therefore they can't purchase them, so house prices start to drop. Importantly though, we do see household wealth and debt still at a fairly significantly high level, so net worth sitting up here, the levels of liabilities down here. So broadly it's not that significant, but certainly worth speaking about. I think one of the things I want to bring up now, I think, is just to understand that this is going how it's supposed to go, isn't it?
Yeah, it is.
So the RBA, government, both in Australia, Federal Reserve in the US, laid out a plan. We're going to increase interest rates to stop inflation. We're seeing inflation starting to come down. Right? So that's really positive. That's and I think certainly that's also financial markets. They've seen that, and we've started to see a bit of a swing up in financial markets over the course of the last few months.
And I think it's a great point, Cam, because financial markets too fear inflation more than just about anything, right? And it's because we know the only way to curtail it is to have restrictive trading conditions for an extended period of time. So the fact that inflation, the early numbers are showing that it has dropped reasonably swiftly, if they can pull off a miracle and get it back to a much lower rate quicker, then arguably the show goes on faster, right? And that's kind of what financial markets are talking to a little bit at the moment. So it's a big financial experiment the last few years, I must say. That's what it feels like to me. With through no fault of anyone's, it's been health crisis, and subsequently it's had to be dealt with financially in an unusual or unorthodox way. But it's so far
it's monetary policy at work, isn't it? So the interest rates came down to help stimulate the economy, and that
worked.
That worked, and now interest rates are rising to bring the economy back and get inflation under control.
So just in terms of, say, equity market performance, we've just run this back for the last 12 months or so, but Andrew, you want to talk through this?
Yeah, so throughout most of last calendar year, the markets were on a downward trajectory. There was a couple of little periods where there was brief recoveries, but that, and we were chatting about this before, but that by and large spoke to markets potentially pricing in, the impact of the continued high inflation and interest rates. So perhaps it might have been pricing in the fears of a potential recession at some point. And as the data has started to demonstrate a bit of a slowdown in, a pullback in inflation. We've seen a recent recovery in all the key indices. So here and abroad. And
that, as again, Shane, we were talking about this off air. We need to save our best moments off air for on air, I think. But anyway, we were just talking about how that just rewards patience over time, doesn't it?
Yeah. And look, and we talked about it late last year in terms of the fact that we appreciate fully how scary times can be when markets are extremely volatile. And it's such a nice thought now, even though there's so much more water to go under the bridge, the fact that we've seen a little bit of reward for patience. I think all investors have breathed a bit of a sigh of relief that, markets have been a bit kinder to us. Bond markets will come to shortly, been a bit better. And that for mine is probably the most telling part of all this, even though those numbers, particularly look at the NASDAQ, still negative 15 over 12 months. Still a pretty ugly number. But if we were to extend that out, I mean, just see that longer term chart there. I mean, the returns have been, over the last 3 or 4 years still quite okay.
Pretty good.
They've just been so volatile in the last 12 months. As I said, most importantly, I'm really pleased for all investors that we've seen just a little bit of, reward come back.
For patience.
Into the portfolios,
that also extends into bond markets as well, right? So, we did see some of these numbers when we did this update in December. There was some minus 14s for Vanguard, for the global bond market. Some of that has started to pull back as well. So as the inflationary environment starts to become get under control, we're starting to see some money flow back into bonds.
Yeah.
And so subsequently you're getting rewarded over time. And, as we said last time, I think bond investors will be rewarded for patience because they will go back to parity. Their prices will go back to parity, which means you pick up all that downside that's been created.
And importantly, on a yield basis alone, and we're looking at seeing what the net return has been, but yield is pretty healthy now, right? Given bond valuation, and they should be because valuations have come down.
2-year 10-year treasuries, 2-year treasuries in the US, 4.5.
Yeah, right. Yeah.
The 10-year numbers are less, which means we have a inverted yield curve.
Yeah, but I mean that's. Maybe I could digress there slightly because that's interesting that 10-year is lower. But a lot of the speculation still is around about this kind of rapid raising of rates to curtail inflation really quickly. We haven't seen that kind of interference previously. But the discussion is all about, will rates in fact return or trend down again, and how quickly will they start to trend down again? And it's highly probable, and perhaps the fact that longer term US bond yield is lower than short term is very indicative of the fact that we're probably living through a period of restrictive economic conditions with higher rates, where the probability of that to decline at some stage in the next 12 to 24 months is quite high.
It's high. Yeah, that's right. Well, that's what the bond yield talks to, right?
Yeah.
All right. Anything else we want to round off on?
Look, I think from my point of view, I mean, the part that I'd sort of just also, sort of note in all this is that the data is very interesting, I think, at this point in time. But what the data doesn't speak to is a little bit of the noise that we hear on the news and the hysteria that's out there.
Yep.
And even still to this day, it still for me feels observationally that the media would have it that the world is still in a very tricky spot, and probably arguably more tricky than it probably is.
Yep.
But having said that, we've got a lot of issues still to resolve. We've still got obviously Russia and Ukraine. We've got the risk of China and Taiwan. So there's geopolitical risks that are out there, and we can't deal with those.
No.
We can't influence those. But it's noted that quite often what we hear or believe is worse than what actually is. And I think sometimes seeing the data like we've presented today is quite refreshing to kind of remove the noise and all the hysteria out of it and just focus on what's actually happening. And again, as I said before, reward for patience I think is so nice, particularly that we all saw last year and all felt it, the difficulty all investors face, kind of holding their nerve.
Yeah, that's right. Very well said, mate. All right, the disclaimer, this is clearly general advice. This is not personal advice. If you need personal advice, come and see one of the wonderful advisors at IWP. Thanks, everyone. Look, appreciate all your time. Hope you made it to the end. I really enjoyed that. So look forward to seeing you next month.
Bye for now.
Bye.
Bye.